For over a decade, luxury felt bulletproof. Louis Vuitton could raise handbag prices twice a year, and people would rush to buy before the next hike. Dior could open a flagship in every major city on earth and still have wait lists. Hermès could sell a scarf for $800 and customers would call it a bargain. The industry didn't just grow, it felt invincible. Then 2024 happened. LVMH's fashion and leather goods division, the segment that houses Louis Vuitton and Dior, the supposed crown jewels of global luxury, posted a 6% decline in Q3, followed by a 1% drop in Q4 that ended one of the longest growth streaks in the history of the industry. And across the broader luxury market, consulting firm Bain reported something that would have been unthinkable just 2 years earlier. Two out of every three luxury brands shrank, not stagnated, shrank by H1 2025. LVMH's revenue had fallen 4% to €39, 8 billion. Net profit dropped 22%. This is not a blip. This is not a hangover from the pandemic boom. Something has fundamentally changed about how people around the world relate to luxury, and the brands that don't understand that shift are already falling behind. The market split no one saw coming for most of the 2010s and early 2020s. The luxury industry operated like a tide, it lifted all boats. A rising middle class in emerging markets, booming financial sectors in the West, historically low interest rates, and an influx of new wealth meant that almost every luxury brand grew almost every year, almost everywhere. That era is over. What replaced it is something more brutal, a market that now separates winners from losers with almost surgical precision. Hermès kept delivering double-digit growth while LVMH stumbled. The gap between them isn't a coincidence, it's a lesson. Hermès operates around one brand, one message, and tightly controlled scarcity. Birkins have waiting lists. Hermès investors value the company at nearly 53 times forward earnings. LVMH trades at around 20 times. The market is telling you something. LVMH, by contrast, owns over 75 brands across 5 divisions: fashion and leather goods, wines and spirits, perfumes and cosmetics, watches and jewelry, and retail. For years, that diversification looked like genius. When one category softened, another picked up the slack. The portfolio balanced risk. A rising middle class in emerging markets, booming financial sectors in the West, historically low interest rates, and an influx of new wealth meant that almost every luxury brand grew almost every year, almost everywhere. That era is over. What replaced it is something more brutal, a market that now separates winners from losers with almost surgical precision. Hermes kept delivering double-digit growth while LVMH stumbled. The gap between them isn't a coincidence, it's a lesson. Hermes operates around one brand, one message, and tightly controlled scarcity. Birkins have waiting lists. Hermes investors value the company at nearly 53 times forward earnings. LVMH trades at around 20 times. The market is telling you something. LVMH, by contrast, owns over 75 brands across 5 divisions: fashion and leather goods, wines and spirits, perfumes and cosmetics, watches and jewelry, and retail. For years, that diversification looked like genius. When one category softened, another picked up the slack. The portfolio balanced risk. In 2024, it multiplied it. Fashion slumped, wines and spirits slumped, watches slumped, perfume and cosmetics slumped. Everything moved in the same direction at the same time. And LVMH had 75 brands worth of operational complexity with no easy way to pivot. Each division needed resources, each brand needed attention. Supply chains that seemed efficient in a boom became fragile under pressure. Marketing that once felt aspirational started to feel scattered. Scale stopped being an asset. It became a burden. To understand why the market cracked, you have to understand what luxury brands did with their decade of dominance. They raised prices relentlessly. Between 2020 and 2023, the biggest luxury houses pushed through price increases of 8 to 10% annually, not once every year. Louis Vuitton hiked handbag prices multiple times in a single year. Dior increased perfume prices. Bulgari raised jewelry prices. And for a while, it worked. Customers bought faster, worried about what the next hike would bring. Higher prices signaled higher desirability. It felt like the rules of economics didn't apply. Then interest rates rose across Europe, the UK, the US, and beyond. Equity markets turned volatile. Real estate, the primary store of wealth for the global upper middle class, came under pressure in major cities from London to Sydney to Toronto. Inflation hit groceries, mortgages, energy bills, and transportation simultaneously. And the aspirational buyer, the professional who splurged on a designer piece for a promotion, a milestone, a birthday, started doing the math. To €500 bag now competed with core expenses, entry level luxury quietly slipped out of reach for millions of people who had fueled the market's growth. The customer base shrank and nobody talked about it. For the wealthiest buyers, the calculus shifted to just differently. Instead of asking, do I want this? They started asking, will this hold its value? Spending rotated toward assets with clear financial logic. Gold jewelry outperformed leather handbags. Vintage Rolex felt smarter than new seasonal clothing. A pre owned Hermes Kelly seemed safer than a new ready to wear collection. Luxury became strategic, and the brands built for impulse suffered most. One of the less discussed drivers of LVMH's pain wasn't a collapse in demand, it was a collapse in where demand was being captured. Luxury pricing has never been uniform. A handbag costs more in Shanghai than in Paris due to import duties, taxes, and currency buffers. A watch costs more in Sao Paulo than in Milan. These gaps were manageable when travel was complicated. They became a serious commercial problem when travel became routine. An affluent buyer from Brazil, the Middle East, Southeast Asia, or anywhere with a weaker currency now does the arithmetic before they shop. A bag that costs €3,000 in Paris might cost the equivalent of €3,800 back home. For one item, the math is interesting. For three or four, flying to Europe pays for itself. Global luxury corridors, Tokyo, Paris, Milan, Dubai, London, saw surging foot traffic from international buyers who weren't missing out on luxury. They were simply purchasing it somewhere else. LVMH still made the sale, but the sale was booked in a European store with European operating costs, while the high margin boutique in the buyer's home country sat underutilized, carrying the same fixed costs with fewer transactions. Regional teams found themselves quietly competing with their own company stores in other countries. Influencers began posting where to buy luxury cheaper guides. The information spread. What had been individual arbitrage became a global behavior pattern, and there was no clean answer to it. Alongside the economic pressure came something more structural, a genuine shift in values among younger, affluent consumers worldwide. Gen Z and younger millennials, who represent the future of the luxury market, are not behaving the way their parents did. This isn't an exaggeration, and it isn't a trend that's going to reverse. Research consistently shows that this cohort across markets from New York to London to Mumbai to Lagos values experiences over possessions, authenticity over status, and meaning over display. A $3,000 handbag competes with a trip to Japan, a festival season, a photography project, a wellness retreat, and increasingly the trip wins. Not because younger buyers can't afford luxury goods, but because conspicuous consumption has lost its social currency in their peer groups. Carrying a bag covered in a designer's initials feels, to many in this generation, like paying a brand to advertise on your behalf. Subtle branding has gained ground, vintage has gained ground, thrift has gained ground. Influencers who find an overlooked €80 piece and style it inventively generate more engagement than those unboxing a new season release. Quiet luxury went from a niche aesthetic to a global mood. Sustainability added another layer of pressure. This generation asks questions that luxury brands struggle to answer comfortably. Where was this made? Under what conditions? What is its environmental footprint? Brands built around exclusivity and mystique find transparency difficult. It risks demystifying the very thing people are paying for, but refusing to engage reads as evasion, which is worse. The old formula, craft heritage, French elegance, aspirational imagery, doesn't land with this audience the way it did with previous generations. The narrative hasn't been updated, and the gap is showing. At the worst possible moment, LVMH also faced a trust crisis. Reports of data breaches at Louis Vuitton and Dior exposed names, contact details, purchase histories, personal preferences, and stylist notes. VIP client lists were compromised. Private communications became accessible. This might sound like a standard corporate IT issue. In most industries, it would be. In luxury, it cuts at something foundational. When a client spends 5,000 euros on a bag, they are not just buying leather and hardware, they are buying a relationship built on discretion, exclusivity, and privacy. The in store experience, where a sales associate knows your name, your size, your preferences, your history, is a core part of the value proposition. High net worth individuals are, by definition, targets. They expect their data to be protected with the same care applied to the products they purchase. A breach doesn't just create a practical inconvenience, it exposes the architecture behind the mystique that client data sits in the same kind of vulnerable systems used by anyone else. It makes the exclusivity feel like a performance, and it makes new customers already cautious, already questioning whether luxury is worth it, hesitant to share the personal information that makes a luxury retail experience possible in the first place. Rebuilding that trust is slow, expensive, and impossible to fake. LVMH has read the signals. The question is whether the response is sharp enough. The most revealing move came when L. Catterton, the private equity firm backed by LVMH, led an $800 million investment in FlexJet, a private aviation company. On the surface, this looked like an odd bet for a group whose core business is handbags and champagne. In context, it was a declaration. Wealthy consumers are shifting spend toward time, access, and experiences. A private jet solves problems, it creates memories. A handbag sits in a cupboard. LVMH is betting that the future of luxury is not an object you own, it's an ecosystem you belong to: private travel, premium hospitality, exclusive dining, curated access to events and places that most people cannot reach. On the portfolio side, the group sold Off-White and bought back the Stella McCartney stake. Conversations continue around Marc Jacobs and a potential Sephora spinoff. The strategy appears to be a tightening: concentrate resources behind fewer, stronger brands positioned at the top of the market rather than spreading across dozens of labels at different price points. Manufacturing investments in the United States aim to protect margins from tariff exposure and position select brands as domestic products for American consumers who increasingly prefer locally made goods. It is both a logistics hedge and a marketing play. Digital investment continues: upgraded in store experiences in key cities, stronger social commerce infrastructure, influencer strategies that speak to younger buyers in their native formats. The luxury market isn't dying, wealth is still being created. In more places than ever, there are more high net worth individuals globally today than at any point in history, and that number will continue to grow. But the playbook that worked for the previous 2 decades no longer applies. Brands that offer genuine scarcity, real exclusivity, not manufactured aspiration, will continue to command